Hey, what's up? This is Dudediligence here, and we are making again all of these short videos. Can you guys see? We're making this fish. You see this fishy? You see this fishy? Yeah, dude, black sea bass, really nice. We're steaming it, and today we're gonna, other than showing you my fish, we're making some cabbage. Okay, and I'm apparently on a sort of like a semi-carnivore whatever diet, and so then I'm actually making some progress. You see. I'm losing some weight here. Anyways, today we're gonna talk about like how do you hedge your downside exposure, or more likely, in a market where everything's going down, or a lot of the big four, right? The big four streamers like Graham, Stefan, and Kevin, and all of them claim that they sold their positions and all this kind of stuff, and there are a lot of controversy on the market about a lot of garble stocks, small cap stocks, meme stocks, whatever, even blue chip stocks too. So how would you generally, adjust your portfolio to an extent where it's sort of like hedge on the downside a little bit? So there are two situations you need to consider, or maybe three, depending on how long this video I want it to be. Because on a phone, I can actually count how many minutes I've already talked. For those of you who just want to watch a 5 minutes video, hopefully this video is only going to be 5 minutes. So a first situation that you have to ask yourself, okay, sit down on your bed or anywhere that you really like, or on your wife's lap right beside her, or do some random cuddly situation that you're in, or just tell your kids to sit there and just do their hair or whatever, and then just ask yourself this question: do you see how much of those markets equity value, which just means, like, for example, Apple right now is around $160. How much of that $160 in reality do you think Apple worth? Okay, we're just using Apple as an example. Tesla too, right? Tesla is somewhere around 989 or whatever, or 1065 or whatever that price. I actually haven't checked Tesla for a little bit. Or Microsoft, ideally around like $297, $300. How much? Think yourself in the shoes of a regular institutional investor. How much do you think of that $300 on Microsoft, that $160 on Apple is bubble? It's like inflation bubble or whatever bubble. Like in actuality, how much are you willing to pay for one share of that stock? Minus all the hype, minus all of the conventional expectations that other people are giving you. How much are you willing to pay for that? Okay, and then pick a random number, or I'm gonna pick a random number here. It's not based on calculations or anything. Let's just say ideally, I think Microsoft only worth $250. So that means you have $50 downside. Okay, so now you're facing with the decision whether do you want to sell it right now and wait until it drops to $250 and just missed out on all of the volatile actions in between because you just don't like to look at your portfolio all the time. Then everybody knows the market is going down, right? And we don't know when it's gonna end, when it's gonna start rebounding. So it will be the safest way to do that. And then you just wait. You wait until a critical point where it hits your buying target and you're buying in, right? But in that situation, what you have to figure out is how much. I know a lot of you buy at FOMO in a very, very high point. I know. For those of you who are not laughing here, okay, I'm laughing because been there, done that before years ago. And then what you guys have to really figure out is it really worth it for you to cut the losses? Are you gonna put the money in the market forever? Like if you're putting it for 6 years, I can tell you in 6 years, it's probably gonna climb back to the level that we are right now, according to pattern. In 6 years, probably. And in 6 years, you're going to generate more income. And then if you do a periodic buy-in, like an annuity into the stock market, you probably will make more money anyways, right? Then that's one of the things you have to figure out is it worth this to cut loss? The reason why a lot of retail investors don't want to cut their losses is because, well, it just looks bad, right? For example, like if you're an investor in GME, you bought in $254, it's now $100. Well, it doesn't look so great on your balance sheet or on your bank statement, does it? And a second situation what you can do is you essentially need to figure out is like, okay, so if you decided to stay there, then just stay there. You might have some dry powders on the side, and maybe you reaches your price target where you think this is a fair price to buy in, and start buying in, and then maybe put your money in there for a couple of years, and eventually all of them will increase, right? A second situation is you didn't buy it at the highest part, you still maintain a little bit of profit. So what you would do here, again, we're not financial advisors. We're not financial advisors. We do not give financial advice. And everything we say on this channel is for shits and giggles, right? Let's just suppose that, you bought in GME around $60. It's around $100. And a lot of the times it's all the conventional wisdom, the YouTube FUD or whatever hype that is keeping you holding this thing. And then now you gotta look back and think about this. Is the profit I make right now, do I think it's already enough? Personally speaking, I think any stock make around 20%, I'm already exiting. Like, I don't care. Some people are like 100%. Like, I'm already exiting. There's always going to be better trades out there. And especially in a volatile market. If I am me and I'm holding GME, I bought it at 60, I would probably just sell it and wait until a point where, maybe there are new money flowing into the market and it's time to do another dump and jack its value up. Again, for GME, we haven't really done a detailed video on GME. Sorry, the steam is steaming up a little bit on my little fishy here. Ideally, GME's real price somewhere around $50 to $60, right? You buy it at its cost, and now you have a FOMO profit of $40, right? And then you would just sell it and have the dry powder on hand and be like Warren Buffett and just wait. And if you see some like bottom out or see some already like continuous day of recovering actions, you buy it back in and just ride the wave again, right? Another situation would be you only make 2%. You only make 2%. The greed inside of you is telling you that, oh my God, I just hold it a little bit longer. Maybe it's going to rebound. But the thing is, the probability of a rebound is how much? Like, how certain are you that it's going to be a rebound, or you just don't know at all? When you don't know something, when there's uncertainty in front of you, you have to pick between these two situations. One is also based on your personality entirely. One is, I am a very risk-averse person. That means I don't want my money at risk. Then what you do is liquidate and just take the dry powder and wait, right? Another thing that you can do is you look at your risk tolerance level and be like, hey, maybe I just thin my position a little bit, so when it actually go down to my break-even line, I can be like, whatever, I'll just toss it or whatever, right? Then what you do, if I were you, right, if I'm me, what I would do is, let's just say I'm only making 2%, I set up a cut loss line somewhere, stop loss line somewhere, right? Ideally, a little bit lower than break even or at break even, depending on your risk tolerance level, and then I'll probably just liquidate 1/3 of the position or 50% of position, as of right now, because the market isn't really looking that great, especially with the FOMC meeting coming up, right? And the third position is you're like, I don't really care about my upside exposure. I just want to hedge it. How would you hedge it? How would you hedge your position? Well, there are two major ways to do it. One is via ETF. One is you can short a specific stock that is on the same sector of your stock, okay? Like, for example, you would do is SQQQ, buy some calls, buy some SQQQ shares. If you think, suddenly there's going to be a really bad movement coming up next week on the NASDAQ exchange, or on the NASDAQ or on the Dow Jones, get some, UVXY, get some SPSD, I think that's what it is. There are a lot of negative, inversely correlated inverse correlate to the NASDAQ ETFs that you can buy. Some of them are leveraged. That means 1% drop or you'll use 3%, increase in your portfolio, or you can do it as the 1-to-1, 1% drop will give 1%, the profit. If it happens to go up at 1%, then you lose 1%. You know what I mean? This is a way to do it. And then you can do a combination of those. You can, like what I like to do, I like to, buy a little bit of the call side, calls or whatever, to hedge some of my negatively pegged exposure, like for example, tons of shares of SQQQ or call options, or maybe I think the Japanese market would drop, or maybe I think conversely the US dollar would increase because interest rate increase. That's just normal. Then you do a lot of those positive exposures, and you can do some positive exposures in oil. It's just a matter of fact of how risk averse you are as an investor, how much you want to pay attention to the market, whether you like to wait or frequently place a trade, or you have to figure out is how much money are you willing to lose if this market is going to the shitters. Okay, Again, we're not financial advisors. We do not give any financial advices. Everything we say is for shits and giggles. If you like those kind of content, smash the like button and subscribe. See you guys on the upside. And of course, on Discord, especially on Patreon, I mentioned that there's going to be a basic finance course, a series. And I've already write a script for the first class. I just need to figure out a better setting of filming it and also maybe put some visuals in it. But I'm getting increasingly lazy these days. I have so many obligations to do. So let's see how that video is going to turn out. And there you go. And starting from next week, I'm gonna start tweeting some stuff. Follow us, tag us, ask us questions on Twitter, share some love, like our tweets, retweet our tweets. All right, there's gonna be some very interesting quotes. Some of you might be able to, what we can make those into NFTs. How about that? See you guys on the upside.